I'm so sorry. Again was on mute. God damn it. Oh, just a couple of minutes before the opening. When the VIX is high, it also extends the range. We can have a higher range. 20 is can be like 1-2% ranges. The market hasn't get back inside these ranges, inside this 2-month range here. It's right there hovering in the weekly. It's right in between these two ranges. The daily has taken these lows. This is the adjusted contract, adjusted chart. We have 4 lows here that have been repaired. The market opens down here, it will repair these levels as well. Okay, and well below the 200 moving average. The bond market did not open with a gap. This is not a gap, no, because then the gap would be the market opened below this level, and the market opening inside. The market opening inside previous day, inside last session, previous session. Same goes to the 30 years bond. I'll keep an eye, especially in this market, what is doing now. Inventory, we have a gap. My focus is the gap. The bigger the gaps, the higher the odds have been closed. The lower the odds have been closed. But notice how all this inventory is in weak hands here. Really weak hands here. We have look at this level here. Look at this level here. 1, 2, 3, 4, 5, 6 times was sold. The market was sold from this. Inventory is very weak hands. The distributions have been closed. This day, the second half of this day, of Friday, was very different than the first one. There was good selling in the first half. The second half was another story. But the market, but I am now this gap from previous day in the daily time frame has been closed. Right? I got to close because the market is opening down here. The reference I'm watching, this is 2-month range high. Market is right there. It's inside the monthly, which targets the 40-60. Right? 40-60. Where is the 40-60? Way down here. 40-60, where are you? 40-60 down here. Monthly, weekly, daily low. Oh boy, look at that. It was a triple reference. So there's a look at that. Did you see that? All right, the market is open. Let's see what we have. What the market does relative to the gap. Is the market going to make an attempt to close the gap? Notice how the distributions have been closed. The overnight distribution have been closed. There was a distribution here, and that distribution has been closed. Friday's high is weak. It came exactly from 0, or a couple ticks from 0. This is look at those, where it's being sold, where this market is being sold. I'll see what happens here. Alright. Come on, man. This is what I'm talking about. This is in the daily. We have a gap that the adjusted actually didn't close the gap here yet. But the high of this day is the low of this 4-day range here. Very low volume relative to Friday today. Friday we had higher volume. There's a lot of volatility here. The market is back inside the 2-month range in the monthly time frame. The weekly is right in between those two huge ranges. You know, the lower range is kind of like 18, something like that, 18-day range, and the upper range is like 20. And right now, we are right in between those two. The week is packed with earnings here. Balance, I got balance guidelines in the daily time frame, and gap and spike guidelines in the, daily or to intraday here. This low, which was weak, now has been closed, has been repaired. And now I'm going to rename this as gap closed. If the market comes here, that's the market closing the gap. The mechanical trading continues here. A lot of mechanical trading. Coming back inside, taking this level puts the market inside the lower distribution in the weekly time frame. I don't know why I have it here. Maybe this was the adjusted number. Okay. The Dow Jones is negative in the year. The gap is about to be closed. This is a very old gap back from May. It's one tick from, notice where the market is stopping here, right? One tick below. One tick from being closed. Okay, this gap has been closed now. Now, from these days, this is huge. I mean, it is too far back now, right? But notice how this, really huge amounts, huge blocks of trade here. This was the ES, right? This contract is long gone, right? This kind of volume back from May, right? This kind of volume back from May is the volume that I have seen here, up here, up here. Ten minutes into the session. I don't like the volume. It's going to be lower than Fridays. Okay, this gap has been closed. No, downside continuation. What do we have for that downside continuation here? Overnight low here. Ten minutes into the session. Now, if the market is going to the downside, values all over, we have a gap here. So why you want to go? Why would you go long in this market? Because the market is too short, the market is too low. It's time for a rebound. No, there's no reason here to go to be long in this market. If you are not short, or if you cannot be short in this market, just don't go long. You know, the risk is very high. Stepping in front of a trend is quite risky here. Quite risky. The basics remain the same. The range may increase in days, when we have higher VIXs, the range can increase. let's say 2% or 42, what's that, 80 points, 80, 100 points, right, of range. The dynamics remain the same. The volatility increases, but the dynamics are the same. The dynamics are the same. Do we have any news today? Chicago Fed bill action? No, we don't have any. Tomorrow we have PMI at 9:45. Home sales, Chairman Powell on Wednesday. Tomorrow we have Microsoft, Alphabet as well, Google, Meta, Facebook on Wednesday, Amazon on Thursday. Now, what else do we have for downside continuation? This level here. But to go over here to take this level, the market has to deal first with, you guessed it, right? The 4200. The 4200 right there. Still, I got these levels not because it matters in relative, these big blocks. These are long gone, but what the market did during this time, this could be an area the market can be bought again, because those are different time frames, overreacting. This is gone, for example, right? You have gone. This has been taken. This huge has been taken. This one taken as well. If there is something to the downside, we need this will keep going. Otherwise, it will be just a mechanical trading here. Let's see. This high is very mechanical here. Very mechanical. Back to back mechanical highs. That one, this one too. What happened here? This one as well. I don't know why. I think it was overnight high, or maybe because this. Regardless, I don't care about those. Alright, how big this rally is going to be? How far? This level is irrelevant. I don't know where this came from. I guess it was from this day. This is too old. Too old here. Doesn't matter here. The overnight low has been taken. Now remember, the overnight distributions were closed. Very prominent POC, absolutely weak high here. It doesn't have too much volume. Notice how, just like less than 20 minutes into the first period, in about half of the volume the whole overnight. The rally has taken half back. That's a significant rally there. Oh, look at that. Wow, did you see that? Gosh, man. That was from 20, that was 5 points in one push. Gosh. We're right at the opening now. Come on, man. The weak market doesn't do that. Almost the whole range has been retraced. But that's some impressive rally. The whole period has been retraced, basically. Now, let's see if this market is going to make an attempt to close the gap. Selling from the high, that high is no good. Notice that 42.30, where that volume, that 10,000 volume is. Remember the second half from Friday. The market is back at the opening. 5 minutes, something like that before. How much? Actually, 9 minutes before this period closes. There's some big blocks here as well. We have big blocks up here and big blocks down here, like 1,000, over 1,000. Oh, but I guess those are in 50s. That was an impressive rally there. Now, I want to see what the first 7 minutes of the next period do. Market got inside this weekly range. So far it's being rejected. Let's see if the market rejects this penetration or it comes back inside this. No? But once see the market can close the gap. This high is no good. It wasn't good here. It still is not good. Selling exactly from half back. It doesn't. The market remains inside the 2-month range. Back from May. Okay. Seems like the market's making an attempt to close the gap. Couple minutes before closing the first period. Remember the 10-year bond market did not have a gap. That wasn't a gap. That's an inside day, inside opening. Opening inside previous day range. Increases the also rotation, having a rotational market. From Friday, remember what I say. I was looking at this thing on Friday. This part is really weak. This is good. Actually, this side is good, but this one is not good. If the market comes back in here, okay, I'm going to mark. Now I guess I need to mark this too. Rally high. Is this a rally high? Yeah, this is a rally high. Rally high. What this means here? The market close okay, and also we have a spike here, which is this low, a spike base. I will call this a spike base here. Spike base. For this is to monitor the market. As long as the market doesn't take this high out, if the market doesn't take this high out, The trade remains to the downside. You know, this short inventory is very weak. It's being removed. Not most of them. A lot is still there. The gap has not been closed. Closing the gap changes also many things. It is actually decreasing here. Come on, man, this is really hard here. This is really hard. Boy, the bond market is having a huge rally. God damn. Okay, now things are changing here. You know, because many traders see this as a gap. Okay, the gap has closed, and now we have upside continuation. No, sir. But remember, this is a short covering shape here. Short covering weakens the market. Now, the ES hasn't closed the gap here. ES hasn't closed the gap here. That high is no good. What's on it? Oh. It's pill time. Pills time. This high is no good, man. Marcus making an attempt to close the gap here. That high is no good. Last is right there. This actually was an out. You know, I was short here, this one out. Maybe just took this high out. There's no excess here. The trend remains to the downside, but this is very questionable now. How was volume, boys? Slightly lower, about say at least slightly, maybe 2% lower. Maybe 2% lower than Friday. Let's check. Yeah, 2.5 lower than Friday. The trade is still to the downside. Value is lower, you know. It has a pull. The short is becoming riskier now. but the gap has not been closed. The gap has not been closed. The 4200 is it's not that far. That was some really strong outside bar in the bond market in the 10-year notes. There's penetration of the lower range in the weekly and rejection so far. The market hasn't now the upper side. This is now the upper side of the weekly range. The gap close is also 20. This is also 21 to 20. 20, right? 20 day 20-day range low. This is very important, this one. The market and what? No, week. 20 weekly. 20, not 20 day. 20 week. 20 week. 20 week range low. This low here has been repaired. 35. That's like 20 points. All these stops could have been hit. Have been hit here. There's a significant excess here, and also has closed the gap. No gap has been closed. This gap has been closed too, so that gap is not a reference anymore. I am removing that gap. I'm still keeping this thing. This could be some. I wonder if this can be used. I mean, it's not being used as a resistance. Actually, can it be? I don't think it's going to be support again, but who knows? Notice this. Notice this area here. Okay. From this period, okay? This one. There is another one, but it's only one level up here. Here. Okay. Is this here? Oh, my bad. There's nothing up here. My bad. This is just two pieces together. This is more important. Boy, this is boring. Let's see what this guy has to say.
Professor, apologies. We'll get your audio working in a second here, come back to you. That is obviously one of the key hopes for the bulls, that the macro backdrop is going to reflect some strength in at least consensus earnings, if not for the quarter, maybe for 24. Professor, I think we got your audio back.
Okay,
can you maybe start your answer again?
Yeah, right. Well, let's talk about, I mean, you listed some very good reasons why yields have risen. If it's stronger growth, what would you rather be in, stocks or bonds? I mean, clearly, stocks are the place to be in if we get stronger growth. And I don't mean just for last quarter. You know, I think the promise of AI is real. This year, our growth is being driven by productivity. We actually have payrolls that are only half as big increase as we had last year, and we had less than 1% GDP growth. And this year, we're going to have well over 2% GDP growth. So productivity-driven growth, I mean, first of all, it brings inflation down. It's good for earnings, but it does drive yields up. Higher real growth, more borrowing, more capital investment. I want to be in stocks and not bonds. Let's talk about the deficit. Suppose the higher yields are driven by the deficit, and that may mean higher inflation, you know, in the future with big deficits. Where would you want to be? Stocks or bonds? You would want to be in stocks. Now, you know, Sarah mentioned Japan. I'm not as convinced. You know, Japan 30 years ago, when its stock market peaked off, was as big as the United States. Now it's a tiny fraction. Its economy and an aging population is declining. Yes, it holds a lot of treasuries, but I don't think Japan is the force that it once was. So I'm not as concerned about Japan as being a source of the reason. But when I take a look at these higher yields, especially driven by productivity, growth, and even if you worry about deficits, listen, I'd rather be in stocks.
Isn't the geopolitical picture, though, now, Professor, more short-term, right, more acute, more apt to give investors caution?
Right, it does, and these geopolitical problems are usually opportunities to buy if we look back at history. Now, clearly things could get worse in the Middle East before they get better. You know, you are invited to try to time that in the market. Not many people can. You know, what is the most famous saying in stocks? That stocks climb the wall of worry. And when then there's no clouds in the sky, you're buying too high. I really think geopolitical risk is in the long run an opportunity to buy stocks, not to sell stocks.
I think the point that I was trying to make, Professor, on Japan is that not necessarily that it's, you know, an economic headwind. However, it is a trigger for higher rates in the U.S. because we do.
Now, there's no trend now to the downside because this high has been taken. Now the risk to the downside now is higher, has increased because of this. But still, the market hasn't closed this gap. The market hasn't closed the gap. Okay? If you are shorting here, the stop is, you know, as soon as the market closes the gap, doesn't out. Or if you get back close, really close to this high in the next period.
Same time.
Yeah.
Yeah, right, at the same time. Right. Certainly, I think these higher yields have been the source of this, you know, 5-6% drop that we've seen in the S&P. But then when I think about, well, is that because of stronger growth? Then that means next quarter, that means next year, earnings are going to be better than they would be otherwise. Don't forget, you know, we talk about stronger real yields, and certainly they have gone up. The 10-year TIPS is 2.5. We have to remember when TIPS came out in 1997, they were 3.5, and within 3 years they were 4.5. So in the long picture, these real yields, although certainly higher than they've been in the last 10, 12 years, are not high in terms of history. And if we have real growth that's the source of these higher yields, I don't think that's a negative for stocks.
Finally, S&P year-to-date total return is a nice 11% with dividends, but you strip out the Magnificent Seven, and you're almost 0.5%. Do you think that we need to continue to rely on mega cap tech, or can the rest of the economy join in?
Wow. You know, it's been so unusual that the new bull market, if you call this a new bull market, but usually when you have a bear market, the new market is different leaders, and this is the same leaders as before. They have been magnificent, to say the least, but the difference between the big tech price earnings ratios and small and mid cap price earnings ratios, which are 11 and 12, is one of the biggest that I've seen. So I'm not saying that the big cap are way overpriced or anything like that, but I say I've rarely seen mid and small as cheap as they are today.
Yeah, Russell with the new 52-week low this morning. Professor, we'll stay in touch. Good to see you.
Thank you.
Jeremy Siegel.
As we head to break, here's our roadmap for the rest of the hour. It's Mega.
Okay. This professor, Jeremy Siegel, always have got some interesting things to hear. This market now is the direction of the market is to the upside. If the market would have not taken this high out, the market still would be to the downside. The thing is, we have this interesting thing, right? We have an upside. Market value is lower. The gap has not been closed yet. As soon as the market closes the gap, if it closes, everything changes here, Now, if I was short in this market, you have to rethink now. You have to rethink what you are doing. It was super risky to be long here. Now the risk is in the other side. In the other position. It's interesting to see, right? When you start seeing these kind of things, when you start seeing the market dynamics, how the market works, you start seeing how risk goes from one side to the other side, how the risk increases in one trade, and then suddenly the risk is in the opposite trade. I'm still looking at the gap here. When the gap is closed, if the gap's closed, I start to monitoring value. What the market does? Okay, the gap has been closed here. Gap closed. Oh, look at that. Look at, you have to look at this. You need to see what, you need to be aware of what's going on in the 10 years. No, look at this unbelievable rally. You know, everything happens or started with the fact that this is not a gap. All right? The 10-year did not have a gap. The ES had a gap to the downside, quite a significant one actually. But the 10-year note did not. This is not a gap. It was an inside. Inside opening have increased also being a rotational market. So I expect some rotation here. The other thing is also this looks like short covering. You know, look at this. Look at this trend here. You know, wow, this lows here. You can place a trend line here. You know, all these stops have been taken. This could have been firecracker effect potential that had play out. I know the trade was here. I mean, this trade was completed here. In hindsight, you can see it's easy to talk in hindsight, right? Everything is easy in hindsight. Oh, look at that, man. But look at this market, the difference between this market and this market. This market is about, it's really close. You know, how good also taking this high out. The market or the ES is just getting back inside. And we have this rally high up here, which is the height of the lower distribution. With a strong volume, good volume in the first half, and really weak trading in the second half. The market is now, again, another weak high coming from zero. It came from zero here, previous overnight high the day before. Traders know. Traders remember what the market did. You know that? Let's do the same thing. Let's do what we did last week. This is not going to remove this thing. I'm going to keep this one. The gap has been closed. This one as well. I'm going to keep this 18-week range high, the 2-month range high as well, because right now is this is kind of not that good for me, Oh. How much time left? 7 minutes, almost 7, a little bit more than 7 minutes left here. Look at this. This is something I don't like. Nice taper though. Nice taper on the lower side here. It has nice taper down here as well. Gap has been closed. Let's see if the market can get back inside previous day range. There was a lot of hesitation on this market up here. You know, after the market took the overnight low, the market came back up here, took this high out, but there's a lot of hesitation here. There's a lot of trading here, back and forth, back and forth, back and forth, back and forth. Now we have this level here, and also I have this level. I am taking the B, not the accumulated, but the period itself. You know, really narrow area of volume without big blocks. So. Now, if there is volume here, volume starts to build up here and then tries to take this one again and comes back. Now we will have the same formation on the upper side. The market has taken the base of the spike out, which is this one. What the market is doing now? Ask yourself that. What the market is doing. Not what the market will do, or not what the market was doing. What the market is doing now. What was on A, when the market went higher, went back higher, towards the 18-week range high, then the opening, then the 2-month range high. The market was having a rally, and since the market was trending lower, it was a market at that moment, right? And the very beginning, the shortest time frame, that was sell the rally. I was expecting where this rally is going to where this rally can be sold. But now the movement, you can see A and you can see B. A and B are moving higher, right? So this is an upside movement. The very short time frame could be by pullback here, right? But remember, all the trends are to the downside. The monthly is to the downside, the weekly is to the downside, the daily is to the downside. Just the intraday is doing the opposite. The intraday is doing the opposite. They are doing a completely different thing than all the major time frames. While if you are going to buy this market, you need to understand that, that you are going against the trend, even though you see prices going higher. Okay? So there is a risk here. Look at that, for example, right? There was potential for to form a second distribution. That didn't happen. That didn't happen. The distribution was closed. If C trades inside B, or have kind of like a relative close highs or lows to B highs and lows, it's going to be kind of starting to try sideways. We can have potential here for something that we, some kind of shape we already know. However, we have the overnight, very prominent overnight POC. With those highs, you have I, L, M, S, T, U, and V, right? Pretty much at the same level. Okay? Now, the total volume, 300, and now we have way more than 300 here, right? Just on two periods, we have more than what we have in this, how many hours? 16 hours, say 6, 7, 8, 9, 15 hours of trade. Look where the market, look at the low. Look at the lows. Right? Remember that area? Do you remember that area where C low is right now? Those were 10,000 there. The market struggled, the market did a lot back and forth, remember, around that level. And there's accumulation of volume. That a very narrow area, actually, just two ticks there. It's going to be easy to trade through that area. Now, that volume is being removed now. If somebody was long there, all those longs are, oh my God, very nervous now. They can be averaging now. Now we have these two conflicting pieces of information here, right? And we need to deal with that. We need to learn to have those two conflicting pieces of information. One market that's going higher, which is the intraday, and all the other time frames going to the downside. This high didn't take this low here. Now we have rotation. We have rotation here. Very uncertain market. It doesn't have conviction. The upside movement doesn't have conviction. Now the trend, we have this market going higher. It tried to follow the direction of the right. It failed. a counteraction to the overnight inventory started. When the market got too short, it didn't have continuation to take overnight POC. It took the spike out, it took out the spike, the base of the spike, and now it's the auctions to the downside now. I missed this thing, god damn it. I missed this thing here. And there was a good short here. Because you have, this is your entrance here, right? You got daily, weekly, monthly. This is the entrance here. And what is your stop? Somewhere in here. Stop is if the market comes back inside this range. But it's really hard to do these trades because these trades are against, against what the market is doing right now. Now, continuation we'll see market getting back inside this range, taking half back out, taking the opening, taking this volume out as well, and then more down here. 5 minutes. Inside bar in the bond market. I will start monitoring, but I want to see what happened with value here. Value cannot get inside yet, inside yesterday or inside Friday's value. There's another 42.35. Where's 42.35? This could be important as well. 42.35. This doesn't matter anymore. It has been traded through. Oh boy, it is 10:40. Okay, unless you have any questions, I guess I'm going to call it a day. I wish you guys a good rest of the day. Stay safe. See you tomorrow. Bye-bye.